Hello, everyone, and welcome to our first educational webinar series where Mike and we're doing this together. My name is Alina Trigub. Please type in the chat if you can see my screen and you can hear me well.
Alina, thank you very much for starting the conversation. Delighted to do a joint webinar with you. And for those folks who are not aware, we started to work together. We got introduced by a mutual friend, Corey Boatwright, and you're helping us as a consultant in the investor relations arena. And you have your Samo Financial. You'll talk a little bit about that. But today's topic is to talk about pandemic-created investment opportunity, hotel conversions to affordable multifamily housing. So let's proceed. Well, wonderful disclaimer. We're absolutely required to put up this disclaimer. So this is for educational, informational purposes only. We're not offering any kind of advice, nor are we selling anything at all. If you're interested to invest in our family of funds, please request the private placement memorandum. That's the formal offering document for each fund for accredited investors only. Please read the disclaimer. Thank you kindly. Just a couple of words about me. I'm known as the Big Mike, maybe because I'm 6'4", a bit on the heavy side. I live in Brooklyn, New York, married to my lovely wife for 21 years, 4 kids and the cat, the 5th child. CEO of TF Management Group, real estate, private equity and fund management company. Been a fund manager since 2009 full-time, and a passive real estate investor since 2000. And we have a family of funds. 2 primary funds today is Tempo Opportunity Fund. That is our income and growth fund, and Tempo Growth Fund, that is our growth fund. And we specialize in short-term bridge funding for fix and flip projects and a number of other bridge loans, as well as long-term equity investments focused on predictable cash flow and value-driven appreciation. A broad range of investments, multifamily, self-storage, and including conversion of hotels to multifamily. And I do have a podcast called Big Mike Fund Podcast. If you're bored, you have nothing else to listen to, you're welcome to tune in. And I have a book out available on Amazon. Enough about me. Alina, could you please talk a little bit about you?
Thank you, Mike. It's a pleasure to be here. Again, my name is Alina Trigub. It's great to be working with Mike and the team. I'm really excited about this journey, but my personal journey started many years ago when I got my degree in accounting and started working as a tax accountant, first in public, then in private world, and realized that this was not something I wanted to do for a very long time. But I decided at that point that I'm going to switch to information technology. And so when I switched to career in information technology, my career was progressing, and so were the tax brackets for myself and my husband. And I started to realize that I needed to find a way to lower taxes for our family. So I started looking for ways to do that, and real estate kept coming up. So I was looking at real estate on and off, but never really took action until about 8 years ago when I decided to take action, started doing research. And after many months of research and trying to find property locally, I decided that my ultimate strategy would be an equity partner in syndications. So I started investing in syndications at that time. And after doing that for a number of years and realizing the tremendous benefits of being able not only to save on taxes, but also generate passive income and create generational wealth for my family, I decided to share it with other people, and I started my own company, Samo Financial, with that sole purpose of helping other people essentially follow my footsteps. At that point, I already had a solo 401k. I opened a self-directed account for my husband, so I knew how to do that. I've also invested in a number of syndications, and not only in the multifamily, but also other commercial assets such as mobile home park, storage, assisted living, and so forth. And it was a perfect timing to start Samo Financial and help other people essentially follow my footsteps and also generate passive income, save on taxes, and build something for their families as well. And as Mike mentioned, our mutual friend Corey introduced us last year, and we felt the connection immediately, and over time decided that we want to give a try to work together. And here we are doing our first joint educational webinar together, hopefully many more to come. We are thrilled to have you all here, and we are excited about the content that Mike and I are going to share with you today.
Thank you, Alina, for sharing.
So while the world was waiting and finally got the vaccine to effectively end COVID-19 pandemic, the hospitality industry has been scrambling to buy time to stay afloat. And since March of 2020, US hotels have lost billions of dollars in revenue. Many hotels had to close, especially the luxury ones. Occupancy rates have dropped tremendously. In early May of last year, the occupancy for luxury hotels was less than 15%, and for economy hotels, it was about 40%. And although some hotels were and still surviving on staycations, other hotels are still going through safety and sanitation phases and may not even survive altogether. So someone had to take all of that into account and take into account the growing inventory of these failing hotels. Several folks did, and among these folks are the operator partners that we are closely working with. So what these people decided to do is they decided to convert these troubling hotels to a higher and better use, specifically into apartments. According to McKinsey and Company article dated June 2020, hotel industry studies suggested that recovery to the pre-pandemic levels could take up until 2023 or even later to achieve. And for many hotel owners, this is just too long to wait. Some of them already forced to foreclose, and some of them are forced to sell their property at a steep discount. Unlike hospitality industry, multifamily is remaining in a very high demand, and that is especially true for the workforce housing. Many apartment developers have largely focused on Class A properties that have premium rents and that can justify higher construction costs. In the meantime, affordable housing options have dwindled. There have been ready-made demand for workforce housing that vacant or failing hotels can potentially fit in. And provided that hospitality industry offers in hotels the right fit in terms of the conversion, a few sources of capital readily have been financing and will finance these kind of projects. One thing that I want to make clear is that many of these hotels didn't even do well pre-pandemic. So the pandemic only accelerated their troubles. And this applies in particular to the extended stay hotels in general. And while some of these hotels are slowly reopening, they will not be able to get back to the original capacity overnight. It will probably take at least 2 to 3 years, if not longer. The unfortunate reality is that there is no clear end in sight for the economic distress caused by the pandemic. So let's take a look at what exactly this type of conversion may present. The opportunity entails implementing the two-step process. Number one, it's buying hotels that are in a distressed, underutilized state in the area where there is a higher demand for apartments. And step number two is converting such hotels into multifamily. To implement hotel's conversion, the following steps would have to be executed. Number one, finding a hotel that either offered through REO, which is bank-owned property, or through a short sale. Number two, it's detailing the plan for conversion, including the renovations. Number three, as the units get renovated, start leasing them up. Step number four is once the property is stabilized, refinance it. And lastly, hold it either as a cash flowing asset or sell it to the right buyer. And while it may sound easy, the operator must be very experienced. So let's not sugarcoat this. Converting a hotel is not an easy task. You're essentially taking the building with a specific business model and repurposing it for a completely different use. So the strategy is to find low-rise hotels, buy them at a discount, work on some kitchen area retrofitting and combining of the rooms to increase square footage. And in some instances, some of the hotel units might be split into either efficiencies or one bedrooms or even two bedrooms, depending on the demand in a particular geographic location. So at this point, Mike, I'd like to pass the microphone to you.
Thank you, Alina. So this opportunity of conversion of hotels to multifamily has been around pre-pandemic. And we have one investment that has just gone full life cycle, essentially have gone through full conversion all the way to sale of the property. So we invested in a hotel in Ogden, Utah. It was a boutique hotel. Now, this is not your typical target for a conversion today. The conversion of boutique hotel to multifamily is more of a surgery. It is a precision execution, and it's not a typical exercise. But the point here is this type of opportunity has existed in the past, and a competent sponsor can execute this strategy well. So just to give you a little bit numbers on this particular investment, in May of 2019, we invested only $250,000, and we meaning the Temple Opportunity Fund. It's one of our funds. And the reason we wrote a small check is we were careful and we were trying to dip our toes in the water, in a matter of speaking, in this type of strategy. And what we saw is that successful conversion could lead to tremendous returns. Obviously, there is a risk and a high degree of risk associated with any kind of redevelopment. But a competent sponsor and a good strategy and a good plan, well-capitalized project can succeed quite well. So in this case, the total all-in cost on this project was $13.5 million, of which equity was $2 million, and the rest was debt. First lien mortgage and a mezzanine debt. So the deal was highly leveraged. As a result, it was able to generate completely outsized returns upon exit. So again, the target price was to sell the hotel, convert it to multifamily in 5 years for $18.8 million. What has transpired, the demand for these type of conversions has been very strong, and the property sold in February of 2021 for just over $20.5 million. The original target return on this project was about 25% IRR, and we realized return of over 73% IRR upon sale. So it was 2.2 times multiple, and in 21 months, which is phenomenal. So this is an example of an opportunity pre-pandemic, and now we're going to jump into a series of new projects. But this was a full life cycle, and it was a great observation how the strategy was executed extremely well. So now let's talk about pandemic-created opportunities of these low-rise extended stay hotels, which is kind of bread and butter of this opportunity. So example of deal number one is a project we invested in. Temple Growth Fund invested $1 million in this project in equity of this deal. And actually, Temple Opportunity Fund invested in the mezzanine debt of that project. But let me cover the project first. So this is 88 unit residence in This property was foreclosed, so it was struggling pre-pandemic, as Alina mentioned, and pandemic completely knocked it down, and it became dysfunctional, and the bank foreclosed on the property. So foreclosed assets got sold at a steeply discounted price to the operator that executed the strategy of conversion. And the beauty about the conversion of Residence Inn extended stay hotel is that the kitchenettes are there, and they look like mini apartments. They have a bedroom, they have a living room, and they have, again, a mini kitchen. So the conversion itself is fairly lightweight. Many of these projects can convert within 12 months and fully stabilize and refinance in 18 months. This particular one was 49,500 square feet across 11 buildings. Another great element of this was a proximity to Wake Forest University, as well as Wake Forest Baptist Medical Center. So location is the key, as like any real estate, great location drives the demand, and the success of the project very much depends on that. Let's proceed to the next slide. So here are the financials on the deal. Acquisition price was $4.6 million, and construction was fairly moderate. As you noticed, 88 units and $750,000, which is construction as well as some soft costs. Overall is less than $10,000 a door. It's not heavy lifting. It's very, very doable. And then total budget on the project, total capitalization was $5.9 million. And then the equity piece, the deal was structured with the senior debt, mezzanine debt, and then an equity component. So equity component was $1.5 million. Tempo Growth Fund took $1 million out of that, 2/3 of the equity stack. And then Tempo Opportunity Fund, which is a little bit more focused on income, took half of the mezzanine debt, $700,000 to participate in the deal. And then the senior debt was sold to other investors. So long story short, all in just under $6 million. The projected exit price or exit value, if it's a refi, is around $8 million, generating total profit of over $2 million on a $1.5 million equity, with which generates a pretty good return on equity if it's sold on a 5-year horizon. I believe this project has a little over 20% target return. Yeah, 21.5% target return on a 5-year hold. If this were to sell faster than 5 years, the target IRR would mathematically shoot up quite a bit. But the primary plan as it stands today is to complete renovation and refi the property, return at least 60% of the capital, and then hold for cash flow. Unless somebody, again, comes in, makes a great offer, at that point, sale might make great sense to recycle the capital and invest in the next project.
Mike, thank you for sharing with us this North Carolina hotel conversion. This is a good segue to talk a little bit about Tempo Growth Fund, since this is one of the projects we invested in.
Sure. Thank you, Alina. So Tempo Growth Fund took $1 million position in that $1.5 million equity, and the deal had institutional level waterfall with the sponsor. Obviously, the sponsor or the operator has to make a buck. That's why there is a waterfall, and the investors, and we are the investors in this project, receiving 9% cumulative preferred return, and then 75-25% split, 75% to investors, us, and 25% to the sponsor as a performance fee, until 18% IRR, and then 65-35 split above that. Again, the target return on a 5-year hold based on the projections, a little over 21.5, right around 21.5%. Just a couple of words about Tempo Growth Fund. So it is our pure growth focused fund. It's only real estate deals. The fund is closed-ended, meaning that we started to raise capital in January 2020, and we will close the fund in January 2022. And the fund is diversifying among many investments, but one of the key strategies is the hotel conversion to multifamily. The fund has investments in other strategies like self-storage, distressed commercial debt, industrial, number of other projects. Target return for this fund, net of all fees to investors, is 12 to 18% return on average on annual basis. The key clarification here, this fund is a growth fund. So we invest in projects like this, and they don't cash flow from day one. So this fund is more of a growth fund rather than income fund. So 12 to 18% is projected to be generated upon exit of the fund, not as a cash flow from day one. Just clarifying, as this is very important. We're not trying to miscommunicate. The fund is very tax efficient. It passes through a lot of depreciation, as well as most of the returns come on the back end in the form of capital gains. So it's tax efficient as you can go. The time horizon is 5 to 7 years. Why? Because a lot of the projects we invest in do have 5-year life cycle, and we project that most of the assets should life cycle within 5 to 7 years, but some will exit in 2 years. So an example of that Bigelow project, if there's a great buyer that comes forward and wants to buy the property in 2 years, why not? We'll sell it. We'll be delighted to generate investors a strong return. So 5 to 7 year horizon just means that under normal circumstances, the last asset will exit from the fund within that timeline. The fund is IRA friendly. We don't use any leverage on a fund level. The fund pays 8% cumulative preferred return. Then it returns the capital to investors. And after that, the performance split kicks in. So the investors in Class A units would receive 80% of the upside, and then 20% would go to us as a fund manager at the performance fee. And then the Class B units get 70-30 split. That's a truly institutional waterfall, and we're delighted to have this fund up and running. Just a couple of words about our family of funds in the areas of investing. So we invest in both performing and distressed commercial debt at the low investment to value ratio. We call them very defensive in nature. We like the safety of low LTV and an upside of default interest rate with target returns typically in the mid to high teens. In addition, we invest in value add and performing commercial real estate assets, broad range of investments, self-storage, some performing, some value add, multifamily, including the conversions of office and hotels to multifamily, industrial, and many other commercial investment opportunities. And the hotel to multifamily is sort of a hot sector. We're going, let's just call it hot and heavy in that sector with very competent sponsors and operators. We like it quite a bit. The opportunity is still there, even though we're coming out of the COVID, where at least things are improving and reopening, but still there's a long road ahead, and many hotels will never recover. So they present an outstanding opportunity to acquire them and redevelop for better use, such as affordable multifamily.
Let's go back to our hotel to multifamily conversions, Mike.
Sure, thank you, Alina. Here's example number 2. In this deal, there's a whisper, and I'm going to say it absolutely that way, that this could become another home run project. It's a very straightforward conversion of a Ramada Hotel, Ramada Inn in Mesa, Arizona. And Mesa is a suburb of Phoenix. This property is right across from a light rail train stop, which makes it very accessible by students. I think the train takes students and other riders to 4 or 5 universities, as well as it's just well located downtown Mesa, Arizona. And it's 60,000 rentable square feet. Ramada Hotel looks like a motel. The best way to think about this, you can imagine you have an inside courtyard, you have a pool, you have other hotel amenities, but it looks like a motel 2-story building. And the conversion is mostly to studios, and they become a very attractive alternative for students to on-campus living. The privacy is there, there's better living condition, and it's less expensive than student housing on campus. Also, just workforce housing. Anyone who needs a place to crash, a place to call their own, that doesn't want to pay the rent of a 1 or 2 bedroom, can pick up a studio and enjoy the privacy and benefit from that, and pay the rent substantially lower than what they would pay for a 1 or 2 bedroom apartment. And again, a couple of words about Mesa, Arizona. So there is a joke they call Mesa, Arizona, and I'm not trying to be diminutive in any way. So people call Mesa, Arizona the armpit of Phoenix, meaning that it's a workforce housing. People live there. It's people who make the world go round. People who work hard with their hands, and it's very important part of Phoenix. So it's not an expensive area. That's why affordable housing kind of fits in extremely well. So demographics are great, location is great, and as I said, there is a whisper that this project, well, let's go to the next slide and kind of we'll show the financials. Right, so let me show you the financials and I'll tell you what the whisper is. The acquisition price on this property was 6.8 million. Construction is more substantial, 3.1 million. There's a lot of units work. All the units had to be installed. Kitchenettes. On top of that, all the roofs had to be changed. So the scope of work on this project was more substantial, required obviously great expertise by the sponsor. And legal and working capital was another $1 million. Total capitalization right around $11 million. The project was funded with a mortgage of $6,750,000 as well as the equity component $420,000. Temple Grove Fund took a $500,000 position in that $4,200,000 equity chunk. And the target exit price upon completion of renovation and full stabilization and sale was a little over $15 million. What's really amazing on this project is that the whisper is that there are already interested buyers to acquire the property at a price well above the $15 million. So that's all I'm going to say, and obviously subject to risks and uncertainties. But it feels like this type of projects present phenomenal opportunity. If they get acquired faster than 4 or 5 year hold at a price better than the projected, they would represent substantial return opportunities. I call them home run type of returns. In this project, the standard life cycle is 15 to 18 months to full stabilization and refinancing. Again, construction here is a little bit heavier, and it does need a little more time to reach stabilization. And on a 5 year hold, it's projected to generate a little over 20%. If it sells faster, obviously the numbers will work a whole lot better.
Thank you, Mike, for going over those two extensive examples that both look like, absolute home run. And folks, before I go over to the next slide, I want to remind you, if you have any questions, feel free to type them into the Q&A box. We'll address all of the questions after we're done with the webinar in a few more slides. So prior to considering to purchase a hotel that you're planning to convert, it is always advisable to determine whether conversion is feasible for a particular property. So what needs to happen is you have to answer such questions as, what is macroeconomic environment in the area? What does employment look like? Income growth, population growth, demographic characteristics? What is the current and future market demand? What is the potential competition in the area? What are the state and local regulations to consider? And what are the potential costs that are associated with this investment? So in order to answer these and many other questions, the following 6 feasibility studies has to be performed. So highest and best use, absolutely necessary. Property feasibility, market, site, physical, and of course the financial modeling to ensure that even though we're buying hotels at a discount rate, it still makes sense to go through that conversion and put the capital into that, and it will make sense to sell it at a price that's way above of what could potentially be offered for a hotel this size, considering that it's going to become a multifamily. Let's now go over the risks and the mitigation strategy that are implemented for such conversions. Go ahead, Mike.
Sure. Thank you, Alina. So there are risks. All projects have risks. Any kind of investment has risks, and these type of projects are redevelopment projects. Those folks who follow sort of one of the educational methodologies that I use, I call them investment quadrants, and this falls into investment quadrant 4. All development, redevelopment projects fall into that. The degree of risk is substantial, and you can't state anything other than that. But risks can be mitigated. So let's talk a little bit about risk on these type of projects. So cost and time risk, overrunning the cost and overrunning the timeline. And the mitigation strategy is to put together a conservative budget and a buffered budget and put together capital reserves. So many of these projects are well capitalized, and the investors are prepared to deal with some of these delays as they can take place. The cost overruns could also kick in. As many of us have observed, construction costs are going through the roof. The markets, in general, real estate is doing well. People buying houses, they're renovating houses, and the price of construction materials have been inflating. They've been going up at a pretty rapid pace. So it is a substantial risk, and a good budget and reserves is critical. Zoning. So zoning is an interesting subject. So some hotels naturally are zoned and permitted for multifamily. So example, a couple of those extended stay hotels that I mentioned, well, at least one in Winston-Salem, was zoned for multifamily naturally. So when that happens, there's no need to rezone. There's nothing to do other than to get permits for that property to be renovated and used as a multifamily property. Some hotels are not zoned for multifamily, and it would require a permission from the municipality or a city to redevelop. Now, most towns and cities across the United States are in dire need of affordable multifamily housing. So the projects are very welcome, but bureaucracy can be slow and inefficient, and it could take a good number of months to obtain that permission. So a proper feasibility study is a way to mitigate risk, and obviously obtaining necessary permits and approvals prior to closing on the deal might be necessary. Now, you're going to say, well, if you're going to sit and wait for 6 months, you may not be able to obtain the property. And there is some risk associated with that. Some projects have a pretty good feasibility study, and there's a good belief that the conversion is possible. And maybe some soft approvals could be obtained, but the actual permits may take longer to execute. So in general, it is necessary to go through this process, but it is it can be a process to obtain zoning modification. Next risk is a complexity to convert. So complexity to convert, these type of projects are not for entry-level investors. It's the complexity is too high. Managing a hotel through the conversion, converting it incrementally, dealing with complexity of construction on this scale requires very, very experienced operator. And then selection of easy to convert hotels is one of the key risk mitigation strategies. As I mentioned earlier, extended stay hotels fit the bill. And there are somewhat heavier lifting. Some of these Ramada projects require more work, but experienced operator can execute the strategy fairly well. The next risk is future cash flows, future value, sort of based on a pro forma. So many projects do have, well, all of them have it has a pro forma. Whether it's well developed or well designed is obviously subject to the discussion. But pro forma exists. You can't raise capital, can't do anything without a pro forma. So pro forma simply means projections of what the rent's going to bring in the future, what the expense is going to look like, and what net operating profit will look like. And based on net operating profit and the cap rates that are typical for this type of property in a given area, a price is determined. So the pro forma has risks. And the way to mitigate the risk is to underwrite conservatively. So what does that mean? It means assume the rents that are being projected may be somewhat less than the new product, right? Two, the expenses could be greater than originally projected, accounting for tax reassessments. And in addition to that, cap rates may contract, making the project better, or expand, making the project less valuable. So sensitivity study can take place, and conservative underwriting at the end of the day would point out, does this project make good economic sense or not? I call it the good, the bad, and the ugly scenarios. If the project makes sense in an ugly scenario, it's definitely a great project. If a project only makes sense in a good case scenario, maybe too much risk in a project. And there are things in between. So again, this type of analysis is critical, and success or failure of a project may depend on the degree of conservative underwriting. Competition. So competition is something that every investment needs to worry about. But the good news about affordable housing, there's very limited competition. And all or majority of the affordable housing projects are well received, and they lease up at a pretty good pace. So in general, new construction cannot compete with conversion, as new construction is substantially more expensive, and new developments are pretty much all focused on higher rents than the conversion projects. And they may still call them new development affordable type of a product, but in general, cost per door is substantially low on a redevelopment versus new construction. So they can offer more affordable rents, and as a result, compete better. One of the key other loss mitigation strategies is selecting the right location. In real estate, you just cannot, the rule number one is always location, location, location. If the project is well selected, the demand will be there. Proximity to transportation, proximity to shopping, to other amenities, downtown areas. Again, not downtowns in big cities, but in small cities like Mesa, Arizona, downtown is actually a good area. So again, location is critical, not conversion of a hotel off the highway in the boonies where the people just drive off the highway to sleep overnight and continue their journey. That's not a good location. Location that naturally fits as a multifamily property in a residential neighborhood is a good or a great location. And then the final risk is investment concentration. It takes place with every investment. Anytime you invest in a single deal, whatever it might be, there's investment concentration. So alternative to that is diversification. And the reason diversification works is because you don't know what's going to succeed and what's going to fail. And by spreading the risk among many investments, you mitigate the risk. And in general, on average, you could do better through diversification than without it. So if anything we learned from COVID, diversified portfolio is a way to mitigate risk. Some sectors of the economy or certain locations could be hit pretty hard. COVID hit very hard hospitality, senior living, obviously hotels, as well as shopping centers, malls. And those investors who were concentrated in that took it on the chin. Those who were diversified were able to withstand the storm. So diversification is always a great idea.
Excellent. Thank you so much, Mike. Those were excellent points and great mitigation risk factors. Folks, this concludes our webinar. Please feel free to reach out to either Mike or myself with either questions, schedule time with either Mike or myself if you would like any follow-ups. We're now switching to the Q&A. I see some questions are posted in the chat, and I see some are in the Q&A. So I'll start with the questions in the chat first. So Mike, the first question is, since this is an investment fund, how are the proceeds from refinance or disposition distributed to the investor? Are the proceeds returned or reinvested into other holdings of the fund?
So that's a great question. Probably one of the best questions I've heard in a while. So great question, thank you. So what happens is, on a fund level, we have investment period. So when the fund closes its subscriptions in January 2022, it has 1 year investment period. So if any projects refinance or sell until the investment period is still open, we are allowed to reinvest into the next set of projects. So for example, we invest in a conversion project now and it just exits much faster than projected. We'll get the capital back before January 2023. Again, 22 end of subscription and 23 January is end of investment period. At that time, we may no longer invest or reinvest any distributions. So what the fund will do, it will return the capital to investors. So fund has a waterfall where it will return the capital from sale or refinancing or any income received from operating projects. And that's going to be distributed first towards the pref. Once the pref is current and fully caught up, any additional dollar will be considered return of principal. From a tax perspective, refinance events will be distributed tax-free, obviously, and then the sale events may generate capital gains, but the fund has very, very substantial depreciation benefits from its entire portfolio, and it's very likely that most of the initial gains will be well shielded until later assets in the fund sell. So again, we will reinvest the proceeds if we have great projects. If we don't have great projects, we get the capital back, and we're within the investment period, we will just send the capital back to investors. That's what the current plan is.
Excellent. Thank you for that detailed answer, Mike. Great to see you, Alina. I know you're a seasoned developer. I know a seasoned developer who is also exploring hotel conversions. Are you seeking more deals to syndicate? Thank you, Harold. Good to know you with us and joined us to listen to our webinar. While we have operator partners that we've been working for a long time and they've been pre-vetted and we know them for many years, we always welcome new introductions and definitely open to an opportunity to speak with new operators. Thank you so much for that offer. Next question, what is the optimal size of the hotel motel number of rooms and what is the desired room size? Mike? Right,
so it's another great question. Not huge hotels. We're not looking at hundreds of rooms. So that's sweet spot between, I don't know, 80 to 120 seems to be a good, it's called a sweet spot zone. If you study the markets in general, these extended stay hotels in most tertiary markets are around that 80 to 120 doors. And the room size, they could be small rooms, 200 feet and sort of studio type of configurations, maybe 200 to 400 square feet, small apartments. I don't want to call them micro living, but you're dealing with hotel rooms. What is a typical hotel room? So, 200 square feet, 250, 300, 400, maybe a little bit bigger in some cases. Can they be turned into, it's possible that some rooms could be even 500, 600. But that's not a typical for a hotel room. It's more of a suite type of a room. So it depends, but following the theory of easy hanging fruit, if you're looking for good conversion hotel, I would look for extended stay hotels. I would look for projects that are in good location and can be easily executed on the conversion strategy rather than any kind of boutique hotels. Again, we use the example of Bigelow Residences Hotel in Ogden, Utah, but it's an exception, not the rule. And high-rise hotels, living in New York City, there are a lot of them here. The primary issue here is a massive oversupply of apartments as is. So it's really a function of the market, right? I mean, if you are in a different city where there's a high demand at a specific location, it might become a better candidate. Also, budget-wise, these projects suddenly jump to large institutional investor category once they get above certain size. So to stay out of the big sharks' way, we got to stick with smaller hotels in that, as I mentioned, 80 to 120, maybe a little bit larger. But it's sort of under the radar screen of the big kahunas, and you're better off in the territory where only small fish goes around, rather than trying to compete with large institutional capital to acquire these type of assets.
Awesome. Excellent answer. Thank you, Mike. I don't see any more questions at this time. So unless there's another question or two, we are going to wrap up. I'll wait a couple of seconds to see if there's anything else.
Thank you all very much for your time and your attention and listening. We appreciate the great questions and your interest, and we'll be delighted to chat with you. You can schedule time to chat with Alina actually by going to that link, templegrovefund.com/make an appointment. And you can talk to me by scheduling time through bigmikecall.com. I know a little cheesy, but people call me Big Mike, and the name stuck, and so comes the bigmikecall.com.
Excellent. I don't see any more questions. Again, thank you very much, guys, for joining us today. The webinar is recorded, and we will, of course, share the recording if any of you want to re-listen or want to follow up with questions with either Mike or myself. And we hope you have a great rest of your evening. Take care.
Thank you. Thank you.
Bye-bye.